Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunawilla. I'm the editor of the Chart Report and I'll be your host. We've got a great guest for you today. Ari Wald is going to be joining us. Ari is the head of technical analysis at Oppenheimer. You've probably seen him before on CNBC or elsewhere in the financial media. He's one of the best in the biz, so I can't wait to see what he has to say about this recent pullback. But before we talk to Ari, it's Friday. The markets are closed, so let's take a quick look at how this week played out. All four major indices closed lower by more than 2%. The Russell 2000 was the laggard, dropping more than 3%. Taking a closer look at the S&P 500, we broke the 50-day moving average earlier in the week, and we're approaching support from last August highs around 4,300. If that level fails, it has pretty solid support just below it at 4,200, so we're getting pretty close to testing some major support levels. We've only pulled back about 5%, but it's done a lot to reset sentiment to more sustainable levels. The big news this week was, of course, the breakout in Treasury yields. The US 10-year yield broke out to a 15-year high, so we'll be looking to see if that breakout sticks or not next week. Taking a quick look at sector performance, all 11 sectors closed lower this week. Believe it or not, tech actually led this week. Now, it still fell over 1%, but you wouldn't expect tech leadership in a week where yields broke out to their highest level in over a decade. So maybe tech is trying to tell us something, but it's really too early to tell. On the other hand, consumer discretionary was the laggard this week, falling more than 4%. Anyway, that's enough for me. Let's see what Ari has to say about this. All right, Ari, welcome to the show. Thanks for coming on today.
Great to be on, Patrick. Yeah, glad we're finally able to make this happen.
Yeah, I've wanted to have you on since we started the show, so I'm also glad we could make it happen. Anyway, we got a lot to cover here. The week isn't quite over. We're recording this, as always, on a Thursday, but we've pulled back about 4% from our highs, and it was pretty much at the start of August. We made a new 52-week high on July 31st, and it's been rough sledding ever since. But this pullback is coming at a pretty logical time of year, isn't it?
Patrick, it's been almost too logical. The market has really been following its typical seasonal trajectory to a T, and for us, of course, seasonals are just secondary confirmation. We will never make a recommendation based purely on historically how the market has performed during the calendar month. But when our indicators are confirming what should be a pullback in the market at this time of year, it makes it all the more convincing. And we coming into August, we kind of had noted that this was a time of year where you would typically see volatility pick up. The VIX typically has shown its greatest increase during the month of August, and in turn, the market has typically shown one of its bigger losses. And on top of that, the market was showing some signs of fatigue at around that 4,600 mark. There was a bearish engulfing pattern that occurred at that resistance level.
Yeah,
it was really generally a poor response to what was a good earnings season as well. But you saw the companies typically, on average, put up a negative one-day return after beating estimates there. And so for all those reasons, we were noting that the market looked fatigued. It was in this weak seasonal stretch. And sure enough, the market has continued to sell off. And, our take is that the longer-term positives still outweigh these near-term negatives, that we think this pause is temporary and should prove an opportunity to buy a bull market that's still intact and perhaps still only in its middle innings.
I get it. So you think you're a buyer of this pullback here. But you mentioned that rejection at 4,600 there. That was the March 2022 highs. And that was a big outside reversal day. But I'm wondering, are you watching any other levels now to the downside maybe for potential support?
We are. So here's what we're watching. First off, just based on the seasonal trajectory here, I got an average composite of the S&P 500 looking back at the last 10 pre-election years going back to 1983, what on average, the index will temporarily put in a peak in late July. It'll usually bottom in late August and stabilize through September. So as we are getting closer to that late August period, we are going to be looking for signs of a bottom. What exactly are we going to be looking for is this, as I jump around to...
And you're kind of setting up for a Santa Claus rally, right? I mean, pre-election years are the strongest within the 4-year cycle, but this is kind of that weak spot within the strongest year, right?
That's it. And again, I want to underscore the longer term positives at play that would suggest that pullback should be bought and that strength should return in that seasonally strong period. So for levels, we think the S&P becomes increasingly attractive into 4,300, that being the breakout from the August 2022 peak. In terms of signals, looking for a daily RSI reading of 40. We got that this week. We got that yesterday. Also like to see the VIX, what we call a 50% VIX spike. What we do, we look at the deviation of the VIX from its 3-month low. That helps normalize for these different volatility environments. 50% spike from the recent low point of 13 would equate to about a VIX reading of 20. So it's slowly coming into play. We're getting closer to 4,300. We're not there yet. We're a bull market oversold based on the RSI, looking for a little bit more of a volatility spike, a little bit more duration just based on the seasonal trajectory. But, so far, this has the look of a really textbook seasonal correction that should be bought.
Yeah, like I was saying earlier, it was like August came and then we just flipped a switch and the bears came out of the woodwork. And a couple of weeks ago, we saw a massive spike in the VIX. It was, I think, somebody double check me, but I think it was the second best week since the market peaked way back in January 2022. It was the second best week for the VIX. I think it's surged like 28% or something on like a 2.5% pullback in the S&P 500. So I'm wondering, what do you think when you see that, this massive spike in the VIX when it's really just a 2% down week? That's not too scary, right?
Well, yeah, that's probably capturing this move right here. You could see it probably got up to about that 28, which would indicate a 28% rise from its low. Typically for us, the VIX is an asymmetric indicator. I think what's important to note is the low levels the VIX is coming off of. It got down to a 13. That's bull market confirmation. The fact that you've had such the biggest rise in the VIX, since the start of the run or whatever the stat.
Yeah, second biggest. Yeah,
almost barely noticeable in the chart, especially when you look at the extreme volatility you saw last year. Again, the generally low levels are consistent with a bull market environment, and that underscores the long-term positives at play, despite this little bit of a near-term pickup that we're seeing. As we say, bull markets don't go in a straight line. There should be some expectation of some ebbs and flows along the way.
So I know you do a lot of work on momentum here. So what are you looking at as far as momentum? Is it healthy right now? And was that kind of lift off the October lows we saw and some of the strength we saw earlier in this year? Was that indicative of a new bull market?
It was. That's the roadmap that we're playing by here. Just looking at the action since last October, for starters, October and the entire decline last year was really a classic bear market cycle, both in terms of duration and magnitude. The kind of signs of capitulation that we saw at the bottom, underscored by classic signs of a bottom where you were starting to see selectively areas of the market begin to reverse higher.
What were some of those signs of capitulation? Because you also had a lot of bears saying, waiting for capitulation, and they said we never really got it. They were waiting for that massive spike in the VIX, and it never really came, right? So, what, in your opinion, were those signs of capitulation last year?
Oh, I mean, Patrick, at the low point in October, only 12% of stocks on the NYSE were above their 200-day average. Oof. If that's not capitulation, I don't know what is. VIX got up to 40 level. I mean, if you look back historically, that's consistent with the majority of major market lows. If you're constantly waiting for the VIX to get to the 80 mark and waiting for the great financial crisis, thinking that's par for the course, those types of downturns only come around about once every 20 years, and you're going to miss the majority of significant opportunities and your kind of textbook bear market low. If you look at the sentiment readings, the investors' intelligence, bull bear ratio, actually on par with levels even from the great financial crisis. We saw levels of pessimism that we hadn't seen since early 2009. So in terms of nothing working, depleted sentiment, and just duration wise, typically these bear cycles last about 9 months or so. And then we had a market bottom when you typically see a market bottom. Midterm years, especially historically, have been, we talk about these presidential cycles so much because typically there has been a 4-year equity cycle that had moved with the 4-year presidential cycle, where you would have a major market low every 4 years, almost always for long stretches at a time, usually in a midterm year. And
that's right. Yeah, October has that
last year. And sure enough, market started to take off in Q4 as it usually does.
Yeah, October has that reputation of being a bear market killer in midterm years. So I'm glad you brought that up. But I interrupted your point about momentum earlier. So back to that question, is that liftoff we've seen since that October low, has that been kind of consistent with other thrusts off of a major low? Is that consistent with a new bull market?
Great question. Probably one of our favorite indicators to use to answer that question is actually the percentage of NYSE stocks above their 200-day average. It's a breadth indicator. And what we're going to be looking for is bull market confirmation. At the start of a new bull, we'd like to see that indicator expand. And we've kind of been in this situation where I'd argue almost we haven't gotten full confirmation. For us, you'd like to see over 70% of NYSE stocks above their 200-day average, and yet quite haven't gotten that true broad-based breakaway. And that's what a lot of bears have been pointing to. They've been saying, see, this is all tech. We haven't gotten this broad-based breakaway. For us, though, it's the fact that it's moving in the right direction. And the big reason why we haven't had that broad-based breakout is because the action in small caps. The small caps are really still in their base and they haven't broken higher yet. Rest assured, our estimation would be that once the Russell does finally break above its August 2022 peak and complete its base, so you're going to see a big surge in participation. Until we get there, we've been saying, well, it's at least moving in the right direction. What we're saying is actually from broad-based selling last year, when nothing was working, at least now selling has become more concentrated. And so while buying can still be perhaps narrow, it's not narrowing. It's actually moving in the right direction, moving with small caps as small caps show incremental improvement. And so we haven't gotten that full confirmation yet, but it's moving in the right direction. And as far as bear market rallies go, if this was a bear market rally, it would be the strongest bear market rally ever in terms of magnitude, duration, and a plethora of other indicators that we're looking at that would suggest otherwise. That this is
I think the bears have even given up calling this a bear market rally at this point.
Yeah. So getting there and slow improvement and part of why we still see runway, that we even haven't gotten to that stage of euphoria yet where everything's working.
So what stood out to you in terms of sector performance throughout this pullback, in terms of the negatives and positives?
So even more recently, kind of getting back into the near term, why it's been the right leadership and looking at the more recent action, I think what stands out to us, and rest assured, growth and tech have paused. And to us, technology growth, it was a big driver of strength on the way up, and it has been a source of weakness more recently. I would argue that the weakness has been in proportion to the strength going into it, that as much as tech is pausing, the recovery there is still in play. The real action underneath the surface from our view is the swings between cyclical value and defensive value. And the fact that even on this market pullback, cyclical value is outperforming defensive value. So we get to that conclusion by looking at a ratio of Russell 1000 value versus S&P low volatility. So what we're attempting to do here is strip out, the big benchmarks with growth in it, S&P 500, NASDAQ. And because the Russell value, it's this index of both defensive and cyclical value. If we divide it by a more defensive value gauge, low volatility, you're getting more of a pure cyclical value versus defensive value ratio. And we're kind of showing the weightings of each of those sectors in those indexes. And you're largely looking at energy and financials divided by utilities and staples. And so as the market has pulled back, what we're encouraged about is that this ratio is pushed above Q1 resistance to a new cycle high, indicating to us that cyclicals are being accumulated, defenses are being distributed. This is the right leadership and another reason why we think weakness should be bought here in anticipation for higher highs.
I see. Yeah, you haven't seen that strength in utilities or consumer staples that you'd think you'd see if this was a true risk-off environment, right? That sort of flight to safety.
That's it. Yeah, here's the equal-weighted consumer staples sector, and it hasn't been a safe haven through this market weakness. Lethargic, soft, and especially on a relative basis, looking at it versus the equal-weighted S&P 500, continuing to push at the lower end of its year-long range. And we like using the slope of a 200-day average. And when I say a 200-day average that's gone from up to sideways and now starting to point lower, that leads me to think that there's heightened risk of a breakdown in this sector. And so kind of counterintuitively, or when you're bearish on non-bullish sectors, on defensive sectors, that's a bullish sign, underscoring the market.
Yeah, and there's been a big pickup in the energy sector. It's getting a lot of buzz lately. It's been really strong in the second half of the year, but it kind of took the first half of the year off. I mean, it did take the first half of the year off. So what are you thinking now in terms of energy? Is it a buy here, or is it getting a little bit too popular of a trade?
No, I think there's some runway here. Here's the energy sector spider divided by the S&P 500. And what's notable to us, it's now benefiting from rotation. It had been an area that had been lagging year to date. And through that underperformance, it retraced 38% of its prior run of outperformance from 2020 to 2022. So we think it's finding the lower end of a range. We don't necessarily think it's going to be, a structural secular shift like it was, in prior decades. But instead, the bear, secular bear in energies looks to be over. From 2014 to 2020, we had this significant run, a reversal from over that 2-year period from 20 to 22 that looked very similar to technology coming out of the 2000 bubble. Okay. And even financials coming out of the great financial crisis. But if you look at those roadmaps, after those big runs in tech out of 02, 03 and financials out of 08, 09, they were range bound for a number of years before they were able to finally work higher again. And I think that's what's occurring now in the energy sector. It's this leveling off, tradable opportunity. I think you can really do better in the sector by stock level selection. I think some of the components in the sector, the ones specifically that have already cleared peak levels from 2014 and 2018 in absolute price terms, if you're looking for a long-term structural shift in the sector, I think you could find them in terms of individual components, specifically some of the E&P names.
Yeah, and you mentioned it looked kind of similar to, I think you said tech out of the .com bubble bursting, and also the financials out of the great financial crisis. So in what way did it look similar?
Just that this was thinking the duration of the slide was much more was longer in energy. It lasted for 6 years in this case, but just in terms of big areas, sectors of the market that were under duress for several years at a time, that were big components of this downturn in the market that had subsequently reversed higher. Those were some of the closest roadmaps that we could find, just from these depleted conditions. Actually, for energy, we have sector data going back over a century. That was a century-long low. I think that was the lowest relative level for energy since 1932. And so, our point is that as much as, trends just don't go from down to up. And so while there has been a reversal in that downtrend, again, we think there's going to be a leveling off. And again, you think about tech after the collapse from 2000 to 2002. It wasn't a straight shot higher. You had a big run off the low, and then you were range bound for a number of years between '04 and '06, '07, before tech started to really sustain some outperformance again for the long term.
Yeah, I mean, just the fact that, I mean, you're comparing them to when these sectors had a major problem, right? Tech after the dot-com bubble, financials after the great financial crisis, and energy had its own little crisis when crude oil went negative and the world kind of stopped using crude oil for a few months during the pandemic.
Yeah, that was probably it. But again, and why probably energy, and this gets back into some kind of the growth value divide, and I'd like to kind of talk about some of those themes too, and kind of some of these longer term trends that I think that are at play. When we think about the big divide between tech and everything else, we agreed there's a divide. We agree the divide is probably on par with the divide from the late 1990s into the 2000 collapse. What we've disagreed with, and kind of one of our more differentiated takes on that growth value relationship, is that in the late 1990s, it was driven by outsized returns in the tech sector. I think I have a chart that shows that here. Here's the NASDAQ 100 based on a 5-year rate of change. Into the 2000 top, it was the fact that the NASDAQ was up over 1,000% over a 5-year period, just these astronomical gains. This time around, we've argued that the steadiness of returns in the NASDAQ is actually underappreciated, that we haven't had those types of returns. It's been a steadiness, this much more flat line rate of change. There's been little points when it gets a little overheated, but then there's been checkbacks along the way. There was just a checkback, 2022. We're now on a 5-year basis, a 2-year basis, you could change around different time horizons. It tells the same story. You're actually coming off one of the poorest levels, rate of change levels for the NASDAQ in over a decade. Those excesses have reset, and now we think the secular bull is resuming. That instead,
that's a really
divide, again, getting back to the divide, it's not how strong growth has been. It's been how weak the rest of the market's been. It's that we've had this major collapse in the energy sector, that European stocks as a proxy for value are just starting to get above their levels from the year 2000. And so while, again, post 2000, it was growth having to catch down. This time around, we think the potential, and why we think we're only middle innings of the secular bull market, the potential driver of this next leg for the coming years would be, well, what if value can now start to at least keep pace with growth? What if energy now becomes an investable sector again? What if Europe can now actually start to extend its gains off its year 2000 peak? So again, a little bit of a nuance there. I still think growth on a relative basis is the more attractive risk reward. But the setup is there for some of these value areas to at least start to work after some really abysmal performance. If you look at the value component on a 5-year basis, off a couple years ago, we noted out of the 2020 low, value was showing some of its worst returns, low points that comp to 2008, 1974, 1942, like major low points, again, arguing for it's been really how poor, and it's how the rest of the market has been. And man, if those areas can actually now start to keep pace with growth, we have our second half of the secular bull upon us.
That's a really interesting perspective there. I mean, thinking about tech's 5-year rate of change isn't so hot as you might think if you just looked at some of the first half performance, right?
And it's reset. Yeah, it's coming off its lowest levels in a decade. It's just starting to get going again.
Right, kind of a healthy reset. And I don't think you have a chart for this one, but we've seen a lot of people talking about REITs this week. Bank of America came out with their survey and they showed hedge funds just capitulating their REITs position at their fastest pace since 2008. And you look at the chart and there's nothing really going on with that chart. I mean, it's just kind of range bound, not much to say about it, not much of a trend. So I'm wondering, do you have any thoughts on the real estate sector?
We do. And it gets into some of our thoughts on the momentum factor as a whole. First, just to comment on the REIT sector. And I don't have the chart offhand, but even there's been some incremental stabilizing in the sector. That's all market driven. If you look at the sector divided by the market, look at the relative performance is still straight down. So, all that basing, and I know some people had been noting that, and why we said, no, that's all market driven. That's just a rising tide lifting all boats.
Okay.
That on a relative basis, they've still remained relatively weak. It's still pointing to additional underperformance. And why I bring that up is that they score poorly in our momentum work. We are big advocates for momentum investing. We say we are momentum investors that overlay technical analysis on top of our process. What is momentum investing? The momentum factor is the anomaly. There were stocks that have stocks that have already outperformed over a prior 12-month period are typically stocks that continue to outperform looking ahead. Doesn't work all the time. No style of investing works all the time, whether it's growth investing or value investing. But over various market cycles, I could show you over a century of market data that it has proven to be an alpha generating strategy. What's interesting to note here, and this gets into the market view here, is that the times when the momentum factor typically underperforms by the largest degree is usually at the start of a new bull market. Because at the start of a new bull market, investors will gravitate to the most beaten up junk in the market.
That's fascinating.
And so we followed this trajectory. So what I'm showing in this chart here is the typical performance of the factor. And when we look at these factors, we are capturing performance of the top quintile of the basket, being long those stocks, and you're short the worst performing stocks. And on average, and we're looking at performance both before and after a major market low. We define a major market low as an 18-month low. October 2022 was an 18-month low, it was a major market low. And typically, coming out of a major market low, the factor starts to underperform. And that's what we've seen. That first leg, down leg, was technology. Coming into the year, technology was low momentum. It was poor performance over a prior 12-month period. It was the laggards of the bear cycle. Investors flocked to buy those stocks. The factor underperformed. It's not high momentum broke down. It's just that if you were short the laggards, you would have gotten killed. Tech had that
right. So
great
that
January
kind of
move. Yep.
That shift in leadership that occurs at the reversal in a bear market, that kind of causes that, you're saying? Because what was momentum is no longer momentum, and what wasn't momentum is momentum?
Right. Well, the calculation changes, and now we're at the point of the cycle where the factor starts to perform better. Typically around the 9-month mark, right here is typically, you'll see that factor where you can buy prior outperformance, and that can work looking ahead. And so what's currently in the factor? Well, it's currently long industrials, technology, consumer discretionary. What is it short? It's short banks and REITs, most notably. And in fact, that more recent down leg, that was banks, of the very strong performance in May, June, and July. Now we're at a point, and they still, even after that run, banks and REITs also, that's why I brought up REITs, they're still some of the lower momentum ideas in our work. So as we think about this Q3 setback in the market, we want to be keen. This is the point in the cycle where you want to stay with leadership. What has moved into the calculation? Technology, industrials, consumer discretionary. We want to sell the strength in banks. We want to sell REITs because typically low momentum carries a poor risk reward balance at this stage of the cycle.
That's really interesting. It's a good thing to kind of keep in your mind for future cycles too, is that you often see momentum kind of lag in the early innings there. But, Ari, all this sounds pretty bullish and pretty optimistic. I'm wondering if you have any concerns or anything that you think could potentially derail a rally in the second half of the year.
Great question. Something that we're constantly asking ourselves, where can we be wrong? What gives us the most concern? For starters, what we found is that there's typically a culprit. As we think about market dispersion, what's working, what isn't working, it's not what's working that gets you in trouble. It's not going to be tech. Tech's got a lot of support underneath it, strong momentum. It's typically that there's an area of the market that starts to break down ahead of everything else. If you think back to, banks ahead of the great financial crisis, energy was the culprit going into 2015, 2016, and some of those episodes.
Right. And then those leaders become the source of funds if it gets bad enough, right?
They're the last leg to go. That's the capitulation, but then they're the ones that bounce right back immediately. So it's always difficult to time. Once they come in, you're at your final stages of the correction. But what gets us concerned is if we're wrong about our breadth argument, that internal breadth is directionally improving. And I think for a proxy for internal breadth, we're looking at the Russell 2000. This has been an area of relative weakness. If we're wrong, it's that the Russell 2000 isn't basing and isn't in position to break to the upside, but instead, if it starts to break lower, because at that point, then that's going to pull everything down with it. And we'd run the risk where breadth is then expanding to the downside. So that is something we're watching. Once again, even more recently, the Russell pushed right up into its August 22 high and failed yet again. So we haven't, again, gotten that broad-based breakaway. If that continues as it stands, still in its base, bent, but not broken. So I think generally, our thesis is still intact. If we were to start to see the Russell 2000 actually break lower and fall below its base, then our thesis would potentially be derailed. But of course, you can kind of hedge around that by saying, well, stick with relative strength. That's why we have more conviction buying large cap growth and technology on this pullback than we do, say, small cap value.
Yeah, small caps they just can't get off the mat. I mean, just another rejection there. It's been a heartbreaking chart. But what about yields in the dollar? We call them the two wrecking balls of 2022, at least. But they're kind of making a comeback here. And we're seeing that this week. The 10-year yield broke out to a 15-year highest since 2008. I'm wondering if you think stocks can ultimately get past that. Can they digest some of the headwinds there?
Well, I'm glad you asked about that, because anytime I think about rates and currencies, it's less about my expectations for them, but I always think in terms of the implication for equities.
Right. You're an equities guy.
I'm an equities guy. And for rates, we've argued coming into the year that this would be the year of consolidation, that after last year's big run up, where the breakout was there, broke through prior major high points. It reversed a 40-year downtrend, but we said trends, that doesn't mean it's going to be 40 years of an unrelenting move to the upside, that we think there's going to be a leveling off that's required. And I think we are at that leveling off. We've seen it. And even with rates pushing into its cycle high from Q4 of last year, about 4.3%, I'm unsure if it's going to be a meaningful breakout from here. I think, one characteristic of a range-bound market is that by the time you really start looking good, you start pulling back a little bit. And the same thing on the downside, where right when it looks like it's going to break down, you snap back to the upside. And I think that's the market that is going to characterize interest rates. Regarding the implications for stocks, again, it's for all these intermarket relationships, not high rates, it's not low rates. Stocks like stability. They don't want them rising too fast or rising too fall. The issue last year was, yes, they were rising, but they rose significantly fast, where you had a near doubling in the 10-year from 1.5% to 3% in a near 4-month period, where it was.
So it was more about the pace that they rose at, not necessarily the specific level that the rate's at, right?
It's the second derivative, right? It's how they're how fast.
Momentum. It's momentum.
Right. So as long as there's no momentum, as long as there's stability there, historically, I think a range-bound equities can do well against a range-bound interest rate. In fact, a higher drift would be indicative of growth coming back to the market. At this point, it would almost be a breakdown in interest rates and the threat of recession hitting the market that would be more worrisome. So, as it stands, we want to make sure that the rates don't break higher and really start to run fast to the upside. That would be a threat. I don't think we're there yet. We'll be watching the action of equities in the meantime. And that's my take on rates. And
yeah, and I will say, we just broke out yesterday, so we still got to see if it sticks or not. And I will say there's a lot of people watching that breakout, so I wouldn't be surprised if it failed. And then that would be very bullish for growth and stocks more broadly. But I've been accused of calling failed breakouts before they happen, so I'll try not to do that.
And you don't want to call the breakout so quickly either. I don't know if it beat the, on a closing basis or a weekly close, or if it actually moved to a new high.
It did so on a daily close yesterday.
We're right on the threshold for sure.
Right.
The dollar, it's pretty much a similar story. We think range bound dollar, it's going to be, create price stability, and historically, big, strong equity rallies can develop when the dollar is range bound. And I think even after this, the downturn we had following last year's spike, there's a lot of support underneath. It got a point where you moved below the February low more recently, then you snap right back above it, a failed breakdown, an indication of selling exhaustion on the near-term chart, with a lot of support from the prior breakout level as well. So here too, I think the dollar could be carving out a base. Again, not necessarily expecting significant upside, but dollar stability, intermarket stability, should be good for equities at the end of the day.
Yeah. Well, listen, before you go, I want to get your thoughts on sentiment. We have this sentiment chart here from Callie Cox over at eToro, and I hope my viewers aren't sick of hearing this question, but I think it's a fun exercise. I like to ask my guests where you think we are on this, classic sentiment cycle framework. And I know you've seen it before, and there's no right or wrong answer here, but anecdotally and from everything you're seeing from the sentiment surveys, where would you say that we are in terms of that sentiment cycle?
Yeah. Well, I think there's two cycles going on. There's the very near-term cycle that gets whipped around by the trading of the market, and then where we are in the longer-term cycle. I think with this recent pullback, the case can be made. It's almost the sense of panic again, where the bears are coming back out of hibernation. The bearish worry go round is moving around again, and I think again, based on that, we're getting close to this seasonal bottom. Within the context of the cycle at large, I think we're probably at that optimistic stage. What do I have? Looking at the investors' intelligence bull-bear ratio that has worked its way back to 3. No longer the same pessimism, contrarian firepower as it was last year. But what we're arguing is that the levels of complacency that have historically limited bull market activity are still missing, that we're kind of moving into a neutral territory. In fact, what we're flagging here are prior instances of moving from extreme pessimism to this 3 level. 2016, May 2019, June 2020, there were some intermittent pullbacks in each of those instances, but it didn't align with the major top. And at all those stages, you were still rewarded for buying weakness. And so that's why we're, kind of based on the graphic you showed, I think we are closer to that optimistic stage, and why I think the setup is there for new cycle highs. Again, kind of thinking in terms of the roadmap that we're in, based on the bull market cycle, based on the major low point from October of 2022. If you look back through history, these bull cycles on average typically will last 2.5, 3 years. The median rise from bottom to top, 70%.
Oh, wow.
Okay, well, let's be a little bit more conservative with this. Let's kind of just let's assume that, last year was a non-recessionary bear market. I think 87 crashed, non-recessionary. You had an 88, 89 bull market going into the 1990 recession. Let's say there is that recessionary late economic cycle condition lingering. Let's say 18 months. Let's be conservative here. bottom to top, 50% rise, 18 months. That's being conservative. That's looking at the lower part, just the more muted bull cycles through history. Even with that in mind, our take is that we're only about halfway through this. I think it argues for new cycle highs over the next, 6 to 12 months. And why we're saying that the market is still conservatively undervalued based on where it should ultimately top based on past bull market cycles.
Yeah, and that was actually one of my last questions there for you, Ari. Do you think the S&P 500 has a shot at all-time highs by year end? And I know it's a little unfair of a question, but you can go ahead and do your best to answer it.
Yeah, listen, we came into the year thinking 4,600. We climbed the wall of worry to 4,600. We got there. By year end, maybe not. I think if you're saying looking out if you give me a little bit of a longer horizon, by the first half of next year, I have a little bit more conviction to say, yes, I think we do get those new cycle highs. As much as we're in the seasonal rough patch, I think it could linger into the October. We'll start to move higher again, start to push at that 4,600, maybe even beyond by the end of the year. Unsure if we get the breakout and the new high this year, but probably looking out the next, 6 to 12 months, I would guess that S&P 500
it's achievable.
Will be talking about new cycle highs. Yes.
I see. Well, thank you for being a good sport with that question. And by the way, I like what you said there with the sentiment question about how sentiment can kind of work in two different time frames like that. I think that's a really interesting point where you have, historic pessimism, dating back to levels that we saw in 2008. But then you also have shorter term sentiment where maybe we got a little bit ahead of ourselves earlier this summer, right?
And Patrick, and now you're really going to get to see where sentiment's at. It's one thing, right? They're short. When we were at pushing new highs into July, everyone, the bears aren't making their case. But when the tide comes in a little bit, this is when you really see where sentiment's at. If volatility and if bulls have kind of one foot out the door and the bears are ready to make their move again on these pullbacks, then you get a sense of, how complacent or not we really are. And our kind of feel here is that, once again, bears are going to be quickly making their case that this is, here we go now. I told you, we just got to be a little bit more patient. And, the bearish worry go round is going to start again, is my thinking.
Yeah, we're kind of testing those weak hands for the first time this cycle, I guess. But Ari, we got to wrap it up now, but thank you so much for coming on. I'd love to have you on again sometime.
This was so much fun, Patrick. You guys do a great job on the show. Congrats. It'd be my pleasure to come back anytime. Have a great rest of the summer and we'll talk soon.
Cheers, you too. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.